Hi and welcome to Swiss Codes Daily Market Talk. And happy Thanksgiving for those who celebrate. For the rest of us, the trading volumes will be thin for the rest of the week and the market moves could be accentuated as the dovish shift in Fed expectations is only half good news because it needs the data, the economic data from the US to support that move to be a fully good news. So we will talk about what could go wrong even if the Fed decided to cut the interest rates in December and much more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the calm has returned to the financial markets before the US traders left their desks for the turkey dinner. The US indices added today gains for the fourth consecutive session yesterday as the US yields kept falling. The US two-year yield, for example, that best captures the Federal Reserve rate expectations, fell straight to 3.45% level yesterday. So from today's standpoint, an additional 25 basis point cut from the Fed in December is mostly locked in with more than 80% probability attached to it. And cherry on top, the news that Kevin Hassett could be the next Fed chair to replace Jerome Powell further revived expectations that the Fed will be adopting a lower rate policy moving forward in line with the White House wishes. Hassett is also pro-deregulation and friendly toward cryptocurrencies, everything the risk markets adore. And with Powell's term ending in May 2026 and rumors of a nomination before the end of this year, markets are already picturing a Fed that's softer on interest rates, lighter on rules, and a bit more welcoming toward the digital asset world. So what could go wrong? Well, when the Fed cuts rates, or before it does, the markets react by pulling the yields lower. The latter reduces the borrowing costs for the economy. Lower borrowing costs help companies finance their projects for cheaper price. Lower yields also boost valuations, mind you, because the rate at which you discount future revenues to today makes the future revenues worth more today comparably with higher rates. So the lower the yields, the higher the growth expectations and the higher the valuations. This is why Donald Trump, for example, wants the Fed to lower the interest rates so badly. But that transition mechanism of lower rates leading to lower yields is not guaranteed. That's the catch. If the market, as much as it loves lower Fed rates and lower yields, comes to believe that lowering the interest rates is not the right thing to do, it is not the right decision to make, and that it could revive inflation in the future and require future rate hikes, then the yields could actually pop higher even after the Fed cuts the interest rates. And this is exactly what happened back in September 2024, remember? Within hours, the Fed expectations changed in favor of a 50 basis point cut. And I was having an eye operation that week, so I thought I was hallucinating, but no, I was not hallucinating. They really delivered a 50 basis point cut that week. And then, you know what happened? The yields just spiked after that decision because everybody thought that that was a crazy thing to do. Then the Fed had to pause its interest rate cuts for a full year. So whether the Fed will cut the interest rates in December is just one part of the question. The other part is whether this is the right thing to do. And no one has the answer to that question because we don't have and we won't have the inflation data before the decision, and the data is not expected before the week after the Fed's latest monetary policy decision for this year. So even if the Fed cuts the interest rates, if the inflation data shows heating price pressures the week after that decision, the US yields could still swing higher, and the expectation of those 2 to 4 more interest rate cuts in the US next year would vanish in a way to weigh on risk appetite. So the Fed expectations are to be taken with a pinch of salt, even though rate cut sounds and smells very nice in the first place. So good news is that if you celebrate Thanksgiving, your turkey dinner will be costing around 5% less this year compared to last year, as the price of a turkey is down by around 16% and would cover the significant rises that we saw in veggie and grocery prices. But anyway, coming back to the markets, the risk of a potential policy mistake from the Fed should still remain on the back of your mind as we walk into the Fed decision next month. The market move is fine. It is just fine. As I said, the US dollar softens below its 200-day moving average on the softening Fed expectations for December, but the dovish Fed expectations may have gone just a bit ahead of themselves lately, and the US dollar index could eventually find support near the 98.85-99 range, which is the major 38.2% Fibonacci retracement and the 50-day moving average levels, and hence continue to recover this year's heavy losses for the last stretch of the year. But in the medium run, the US dollar outlook remains negative. But coming back to the short run, the recent weakness of the US dollar was also backed by a recovery in the Japanese yen and also in sterling. But for both currencies, both the yen and sterling, gains remain quite fragile. For Japan, while Takaichi's spending and higher borrowing plans leave the Japanese yen with no other reasonable and natural path than the south, and for sterling, the post-budget rebound will likely be challenged by the softening Bank of England expectation. So if we dive deeper into the UK's economics, yesterday's budget announcement went much better than how I and many out there thought it would. Everyone was obviously bracing for drama and market volatility and even a few teardrops to spice it all up. But we saw none of it materialize yesterday, except for the OBR releasing its forecast by accident about an hour before Rachel Reeves' budget announcement. The measures that Reeves announced were pretty much in line with the market expectations. Hence, they were grandly welcomed by the gilt markets and investors. So we heard a lot of tax rises, about 26 billion sterling, though most of it was postponed toward the election year. Softer stance on benefits, but more people paying taxes. A satisfying fiscal headroom that actually did please investors. But in terms of the fiscal picture of the UK, the things are not looking better today than they were yesterday, because first, front-loading spending and pushing taxes down the road is mostly criticized, obviously, but more importantly, a bleak forecast about the productivity and growth expectations for the UK economy means that the Brits will increasingly be relying on financial markets to finance their government affairs. And that means that investors and not the people will get to decide how much the government will spend and how much pain people in the streets must endure. And the only way to turn this around is to grow as much as you spend, obviously. I think there's a greater chance of seeing unicorns invading the UK skyline than seeing growth match the huge spending. But good news is the gilt yields are significantly down in the wake of the most feared budget of late in the UK, and cable extends gains above the 132 handle. But again, the Bank of England has now the green light to go ahead and cut the interest rates in December, and the latter will certainly cap sterling's upside potential, but as much as the US dollar and the Fed bets allow. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.